All right, it's August 19th, 2025. Today, we're going to look past the usual headlines. We're going to connect the dots between four key numbers and really figure out the story that's driving the markets right now.
So every single day, you're just flooded with all these financial numbers, right? They flash across your screen. But what's the real story they're telling? What's going on behind the scenes? Well, that's what we're here to do. Let's connect those dots, starting with today's most important metrics.
First up, we've got gold. It's holding strong at $3,336 an ounce. Now, with all the economic uncertainty kind of swirling around, it's pretty clear investors are still looking for safety. And gold, well, it's that classic safe haven asset for a reason.
All right, next, let's look at oil. It's trading around $62.91 a barrel. And a dip like this, it's about more than just what you pay at the pump. It could be a signal, a little whisper, that global demand is slowing down. Definitely something we need to keep on our radar.
Okay, now for the stock market's big picture. The S&P 500, it's up a really healthy 14.8% for the year so far. I mean, that's a solid performance, no doubt about it. But the real question is, who's actually driving this rally? As we're about to see, the answer is a lot broader than you might think. And finally, we get to what might be the most important number of the day, the 10-year Treasury yield. It's sitting at 4.33%. And trust me, this single figure, this is the key that's going to unlock the rest of our story today. Okay, so we've got our numbers on the board. Now let's decode what they actually mean. We're going to start with that classic tug of war, you know the one, the safety of gold versus the promise of government bonds. So it really is a tale of two completely different assets. Let's break it down. Think of it like this. Gold is kind of like a valuable rock you keep in a vault. It's worth a lot, sure, but it doesn't pay you anything to hold it. No interest. Treasury bonds, on the other hand, well, those are basically loans you're giving to the government, and they actually pay you back with interest. And this, right here, is the core dynamic. It's absolutely crucial. When that 10-year Treasury yield ticks up to 4.33%, all of a sudden, those interest-paying bonds are offering a guaranteed return that gold, well, it just can't match. And that creates this really powerful push and pull between the two. Okay, let's shift gears now and move over to the stock market to see how this story builds. We're going to go beyond the usual headlines you always hear about big tech because we want to find out what's really happening just under the surface. And this, folks, is where the story gets really interesting. If you actually look under the hood of the market today, it is not just a few tech giants doing all the heavy lifting. No way. We're seeing about 130 stocks hitting fresh 52-week highs, while only about 60 are hitting lows. I mean, that's more than double. And that tells you something important. This rally has legs. So what's behind this? Why is this happening? Well, investors are starting to rotate their money into different parts of the market. They're looking beyond just those huge, famous tech names. They're feeling a bit more confident now that inflation data is cooling off, so they're on the hunt for value. And those few weak spots, the stocks hitting lows, a lot of those are in industries that are pretty sensitive to tariff policies. There's actually a name for this concept on Wall Street. They call it market breadth. And you can think of it like a health check for a market rally. I mean, if lots and lots of different stocks are all rising together, not just a handful of the usual suspects, that's a sign of a much stronger, much more sustainable market. And you can see this broad strength so clearly when you look at the year-to-date numbers. Yeah, of course, tech is having a fantastic year, but look at this. You've got energy, you've got financials, communication services. They are right there in the mix with strong double-digit gains. This isn't just one engine pulling the whole train. It feels like several engines are firing at once. Okay, now let's circle all the way back to that 10-year Treasury yield we talked about, because it's so much more than just a number for bond traders. It's actually a really powerful signal about the entire economy. I really love this analogy because it's just so perfect. The 10-year yield, it really is like the economy's pulse. You can ask, is it beating fast? Is it slow? Or is it steady? That one simple number tells you so much about the overall health of the entire system. So when we see that pulse quicken, when yields rise, it's often telling a story of optimism.
It's a signal that investors are betting on stronger economic growth ahead. And think about it. When the economy grows, it needs more stuff, more raw materials, which then boosts demand for commodities like oil and copper. See? It all connects.
So what does all of this add up to? Let's zoom out for a second and look at the big picture for today. And then we'll look ahead at what could come along and change this entire narrative. Okay, so here's the bottom line for today. We have a market that's feeling pretty good about inflation finally cooling down. That's point one. Point two, the rally is getting broader, which, as we said, is a really healthy sign. But, and this is a big but, everyone is kind of holding their breath just a little, waiting for that big meeting of central bankers at Jackson Hole. So the mood? It's not euphoric, it's more like cautious optimism. And the day's not over yet. Here's what's still on the docket. At 10 a.m. Eastern, we're going to get two key reports, one on housing and another on the economy's future direction. Then, after the closing bell, we'll hear earnings from giants like Home Depot and Medtronic, which will give us a really great read on both consumer spending and the healthcare sector. And all of this brings us to our final big question for the day. The market feels like it's coiled up like a spring right now, just waiting for a clear signal. So what's going to be the catalyst that finally makes it move? Will it be the data we get today, a surprise from earnings tonight, or a single phrase from one of the central bankers? That is the story to watch. Thanks for tuning in.